where does a bond's coupon rate come from? A bond's coupon rate reflects the risk of the bond at one point in time. It was when it was initially issued. So the coupon rate of a bond tells us something about how risky the bond was when it was originally issued. The reason is firms try to sell their bonds at par. Therefore, as we have seen, and we know that when the coupon rate equals the yield to maturity, the price equals par. So in order to get investors to be willing to buy a bond for $1,000 for par, then the coupon rate has to be set equal to the yield to maturity. So suppose we had a bond and the investor said, boy, that bond is really, really, really risky. Given the conditions on that bond, we would give it a higher yield, a relatively high yield to maturity. So if I'm the firm and I want to be able to sell that for $1,000, I need to have a higher coupon rate in order to get you to pay for it, such that the coupon rate equals the yield to maturity. You have a less risky bond, investors say, oh, we don't need as big a return on that, so it'll have a relatively low yield to maturity, so we can put a low coupon rate on it. It'll equal the low yield to maturity, and it can be sold for par. So therefore, in this class, whenever you assume that bonds are issued at par, which is what we do, the coupon rate is equal to its yield when it's issued. And therefore, the coupon rate tells us how risky a bond is at the moment when it is initially issued. The yield to maturity of a bond at any point in time, including today, yesterday, or when it was issued, tells us the risk of the bond at that particular moment in time. And that can change over time. A bond can become more risky over time. So, for example, we're a firm and we borrow, and the market's evaluated us, and a couple of years have passed, and our firm's doing really poorly. It looks like, our market's dying. Take a look at, like a Blockbuster video, which, rented out physical hard copies of VHS tapes and DVDs. And once the industry changed so that movie rentals could all be done digitally and online, there was no need for that. Bonds that looked like a few years ago had a certain level likelihood of being paid may look very, very different given the trends in the industry. So the firms can become more risky bonds can become more risky over time, and as a result, the yield to maturity can be much higher at one point in time than it was at a previous point in time. Likewise, firms can become less risky. Suppose a firm borrows money and for a particular project, and then that project turns out to be incredibly successful. It's bringing in lots and lots of cash. Maybe the firm, because of the success, has gotten other contracts, or the value of the land where the project is has gone up. But things have happened so that investors say there's a real high likelihood that that bond's going to be paid. Things are looking good, and even if they go south, we've got some recourse that is a lot stronger than we did a few years ago, such as selling the expensive land, and so the yields to maturity could be lower today than it was at some point in the past. No reason for yield to stay the same. Life intervenes, business is uncertain, and things happen, and so the risk of a bond can change and can fluctuate over time. So we have 4 bonds. Which of them was the riskiest when it was first issued? Again, these bonds, they're issued at par at the same time. They mature at the same time. They all have face values of 1,000, some annual coupons with the next one in 6 months. So the only difference is their coupon rates and their yields. So we want to know which one was the riskiest when it was first issued. First issued, look at the coupon rate. Riskiest, look at the one with the highest coupon rate. That would be bond A. How about the one that's the riskiest today? Riskiest today, look at the yield to maturity, and look at the one that's the highest, and that would be bond D. How about now? Which of these was the safest when it was first issued? First issued, look at the coupon rate, and you can see B at the time it was issued was considered safer than any of the other 4 because the other 4 all have higher coupon rates. Which one is the safest today? Well, we can look at their yield to maturities, And you can see that bond C has the lowest yield, so bond C is the safest today.